Welcome to the session on security analysis and portfolio management. As you all are aware, we are in the block 3 portfolio management, unit 11 portfolio selection is today's session. Before going for recap, let's come to the introduction. The goal of portfolio creation, I will just read out and then I will explain. Let me give you some disclaimer. While discussing portfolio, I will generally discuss about mostly equities or equity equivalent, that bonds and other things. But that does not mean that those are recommendation in any sense. This is a disclaimer I am giving. It is only purely for academic purpose. I hope I have made myself clear. The goal of portfolio creation is to select optimal mix of asset and why you should choose a portfolio. You would like to have something good which can give you a very good return but risky, but at the same time you would like to have something less risky. That is why some people will keep something in the gold in the house, something in the bank, some money, or maybe some money in the mutual fund. I will typically tell him is a very risk averse person. Some people might be putting more money into the stock market, some in mutual funds, some in fixed deposits or bonds. So they are balanced sort of thing. So this optimal mix of assets provides for that person highest expected return for a given level of risk. So suppose risk I define as a 12. So for a risk of 12, I want a return of 15%, 16%, 17%. I will try to get maximum. Or suppose I get a return of 15%. However I invest the market, it does not give more than 15%. 2026 May. So what I try to do, I'll try to reduce the risk so that risk is low. I have already discussed about Markowitz in his paper Portfolio Selection shows that most of the investors can reduce risk by diversifying their investment rather than investing in a single asset. Good old grandma's statement, don't put all eggs in the single basket. But he went for a very big, very sturdy mathematical research. He developed the concept of efficient frontier, which is a set of optimal portfolio. I mean, you can have different type of portfolios. Oh, I often tell about Tata Steel, Hindustan Lever, or you can have Dabur, you can have some JSW Steel, or you can have something HDFC Bank, you can have on the other side, you can have something like Hindalco. Oh, different type of set of optimal portfolios are there that offer highest expected return for a given level of risk or the lowest risk for a given level of expected return. It's the same thing, other side of the coin. When the market is not so good, you will try to get the highest return but reduce the risk. For a given risk you want to get, and when market is go-go, you try to get the highest return, but you want to limit your risk also. You don't want to go bust. This unit today, what we'll cover, will first provide a logical approach. First, provide a logical approach for delineating efficient set. We will then discuss some of the practical problems of implementing this approach and present another model known as single index model, which is very popular, that simplifies the portfolio selection process to a great extent. So what we're going to learn? First, we're going to learn about a portfolio selection process, but we want to know the benefit and limitations of that portfolio. And after that, we will be discussing about the single index model. So let's move. So to begin with, let me just touch upon one subject, that risk and investor preference. Risk and investor preference are two important concepts in the world of finance and investing, as I was telling. Different investors have different, from your practical life or if you're interacting with people, another thing. Some investors are risk averse, prefer investment that have lower level of risk, even if it means accepting lower returns. Other investors are more risk tolerant, are willing to accept higher level of risk in order to potentially earn higher returns. There are some extremes also. I have seen some people, they put all their savings in the bank, knowing well that bank does not give a high return or very moderate return bank gives. On the other hand, I have seen some people, they put all their money into the securities market. That's also too much of risk because market can, that's not, they have different type of shares, but all their assets are into the securities market. So that's one of the highest risk takers, just below the, I won't say gamblers exactly, but almost like that. It is important for investor to have a clear understanding. So, what is important for you or for anybody you are advising or you will be advising that what is a clear understanding of what is the risk he can take. If it's a very rainy day, will he go out or no? He will take an umbrella and go out, or he will see that rain stops. After that, I'll go out. Three types of behavior can be there. So you have to have a clear understanding of the risk tolerance and to carefully consider potential risk and rewards associated with any investment before making a decision. A small example, which since I have talked about umbrella, suppose you are going to get somebody's house. There is a party or something there is, and there is raining. So if you are risk tolerant, you will just go there. Somebody who's a little cautious, he will take a umbrella and go, and somebody will say, "No, forget about the party. Let's stay at home. It's a very bad night, another thing." So I told you, depending on the rewards, what type of associated with the risk if you take, you should take a decision. And that's what knowingly or unknowingly most of the investors do, or most of the persons do. I should correct myself. Most of the persons do. Here, one thing is that you should have investable surplus because many people don't have investable surplus, but they do have risk taking capacity or something. But that's a different. We are taking the story of, we are talking about those people who have investable surplus and can make a choice. It's a game of choice. Now, let us understand what is the efficient frontier. Efficient frontier is a set of optimal portfolio. Mind the word optimal portfolio. Mind the word optimal portfolio. That means risk and return, there is an adjust balance that offer highest expected return for a given level of risk, or as I repeated, lowest risk for a given level of expected return. Now, how do I go about it? First, I have to define the universe of assets. There are a lot of assets you can invest. Some are financial assets, some are real assets. Real assets are like commodities and other things. Financial assets are stocks, bonds, etc. Nowadays, you have mutual fund, you have ETF, exchange traded funds, you have alternate investment funds. I mean, those are real estate investment trusts or infrastructure investment trusts like that. So there are various type of investment avenues. I am talking about gold. Beside that, real asset gold or gold in the form of ETF or through the mutual fund. Same thing about silver. You can buy. In foreign countries, a lot of big investors, they buy barrels of oil if they think the oil price will go up. Institutionals mainly. So you have to define the universal of assets I will deal in. So in general, an investor, if we look at it, he will generally invest in either gold in the form of gold, that is mainly jewelry, and intelligent people may hold some gold in the form of ETF or mutual fund which invest in gold, some into stocks, some into the bonds, some in the fixed deposits, like that, some in mutual fund, etc. That's the normal human, those who are a regular investor in the market. By the way, I give you data, only 9% of Indians who have investable surplus, they are into the stock market. So you can understand how much money is sitting in the bank or in the form of gold people are holding or in the form of real estate. I mean, I have two, three houses, I collect rent and I run my house like that. Second is collect historical data. So you have to collect historical data about those shares. Now let us narrow down the shares or investable assets group. We take it about bonds. I am not telling because bonds have a defined interest rate, but stocks will give different type of interest, different volatility, different correlation with other market and etc. And on the other side, there are ETF gold, ETF silver, like that. They are also giving return depending on the market conditions and various other macro factors. This data will be used to calculate expected return. This is what you will be doing is this data when you collect, you can use this data to calculate expected returns because past returns are not indicator of future returns, but past return and if you can forecast intelligently, you can guesstimate the return the company is likely to give in a given market scenario and what are the risks associated with that asset. Also, when you are buying two, three assets, as I have told yesterday, you can create a correlation matrix. Okay, if I buy Tata Steel, there's no need of steel, say, is going up, so I can buy JSW Steel or Tata Steel or SAIL. So if I focus on Tata Steel, then comes the next, which will be not correlated to steel. So if steel does not do well, at least that will do. So I can go for some pharma stocks because come what maybe people will fall sick, they will buy pharma. So we have to select a pharma company, right? So a pharma sector. So you decide the sectors I will put in my money. Now calculate expected return. Obviously, steel sector can give some type of return, FMCG sector can give some type of return, real estate sector, I mean, which are in construction and building like DLF or embassy or somebody, what type of return they can give, etc. So these are way you can calculate. And also here I have mentioned one thing. This can be done using various methods such as mean return or capital asset pricing method. Capital asset pricing method may let me go step by step. There is a risk-free return, which is if I put the money in the government bond or bank deposit. If I do it, I get a return of say 5%. Now, if I put the money in the market, I should get at least something extra, say 8% or 9%. Now, suppose you are putting the money into a construction sector, the sector. Now, one builder A, he makes residential houses, which is risk-free. People will buy or people will rent and pay rent. And another is who is building mall and with Inox and etc. So he's taking a little more risk. So if I am putting my money into that builder B, who is making a mall and other thing, etc., my expected return will be higher because I am taking more risk. But if I am putting money with some small builder who will be building residential houses, which are in all likely to be sold, middle class residential houses, I will be expecting a decent return. So this is what the CAPM says. Risk-free return plus what the market return gives and what that particular company can give related to the market. That is what capital asset pricing model. Now, second thing, was one thing is that calculate risk. I have to calculate the risk for each asset using historical data, but that's the only thing I can do. I will calculate the risk for each asset using historical data, whether it will be very risky, how much variations it has earlier. Okay, what is its beta? Beta gives the risk vis-a-vis the market. Because some company has a positive beta and very aggressive, more than one. They, when market goes, they go very high. When market falls, they fall very much. So you have to understand that standard deviation kaisa hai of my stock I'm selecting. General portfolio combination. Having done all these things, so step by step, you have decided the range of assets out of which where you will focus. You have collected historical data. You have based on the past data and future, you have collect expected a return. After that, you have done a study on the risk you are taking, and finally, you have to portfolio combination. Now you have to decide how much of Tata Steel I will buy, or how much of JSW I will buy, how much of Hindustan Lever I will buy, how much of HFC Bank I will buy, how much of pharma company I will buy, or which pharma company will buy, etc., etc. And once you buy 10 or 12 stocks like that, or some mutual fund, another thing, etc., you build up your portfolio. I'll stop here. Just you can browse through the screen once quickly, define the universe of assets, collect historical data, calculate expected returns, calculate the risk, and then build your portfolio. We are not coming to the efficient part of it till now. Okay, we'll come to it later on. This is the portfolio you have made. Now, generating efficient frontier. Now, calculate the portfolio expected return and risk. Now, yesterday I told you A and B like if you take portfolio company A and company B in the same day in the market, both equity may not do the same way. Calculate the expected return and risk for each portfolio combination using expected return matrix, as I told, and the correlation matrix. So, what is this correlation matrix? Every day, like today, if the market has gone up, your two company A and B may not be going up or going down in the same way as it did day before yesterday. Okay, that is the correlation matrix. So how it is correlated with that movement, that is important for you. Plot the efficient frontier. Now, if you these movements, if you start plotting in a graph paper, plot the efficient frontier by graphing the expected return versus the risk for each portfolio combinations. Please note here, plot the efficient frontier by graphing the expected return. You are not doing post facto. Before that, your expected return versus risk of each portfolio combination. So your combination you are putting the data, another thing, etc., and you are trying to prepare a graph. You are putting dot. This is my expected return of the portfolio. This is my expected return of the portfolio. Having said that, the efficient portfolio will be a set of portfolios that offer the highest expected return for a given level of risk. So you calculate, if I take this risk and this is the stock I am buying, this can give this much of return. So this is the efficient portfolio. Or this stock I am buying, I am taking this risk, so this will be my efficient portfolio. So you get various dot. These are your for you of efficient frontier, and if you link them, then you get a line which is efficient frontier. Now select the optimal portfolio. Finally, select the optimal portfolio from the efficient frontier based on your risk tolerance and investment objectives. Now, what you have done actually, you have for a given level of different type of risk, you have chosen some stocks. Now, multiple 5,000 stocks are there. You can choose a lot. Let us focus on A and B, two stocks. You will be calculating the return, future return, forecasting the return. And then you will find this will be the return of the portfolio at this risk. This will be the return of the portfolio at this. So you have different dots in the graph. One side is risk, one side is return. Now, if you connect the thing, you get a frontier. Now you have to select based on your risk, what is the efficient frontier? Which portfolio you will choose from the efficient frontier? I repeat it again. You will collect, you will make dot. So if this is the return, this is the risk, then maybe you are risk oriented, so you can get a higher return at this level of risk. Or you can be here, you get a low return, but you have a low risk. So choice is your, but you are into the frontier, that efficient frontier. That means these portfolios are giving you the most optimum return at a given risk, or the maximum return at that risk. Now I'll move next. How do I find efficient set? Now a little bit of mathematics is there. I will explain it simply. Efficient set is a continuous curve. As I was telling you just now, that if you are investing here, suppose this is the risk and this is the return, and you have chosen key this level of risk, if I take, I get a return of this level of risk, I get a return of this maximum. If you connect those things, then you will get a frontier. Okay. Now efficient set is a continuous curve, which in turn means there are an infinite number of efficient portfolio. So there are many things in this market with so many stocks, so many investors, so many risk and return combinations. There can be many efficient portfolios. But this poses a typical problem to the investor, particularly institutional investors. How can one determine the composition, what combination of assets and how much of that asset? Earlier I did, if I buy 40% of A and 60% of B, you can do the weighted, you can get the return, but the risk becomes different. So, of each of the infinite number of efficient portfolios. Now, this is a big problem. To solve that, there is a lot of mathematical models and other things have been discussed. And as I told you yesterday, Harry Markov is one of the pioneer in portfolio management. He has done a lot of work on that. Now, one method is constrained minimization problem. As we know, an efficient set can be determined by minimizing portfolio risk, because you have calculated from the past performance, you have calculated that level of expected return. This year, Hindustan Lever has done like this. This year, market looks like that, etc., etc. So this can be expected return from EA. Now I know my return is 16% and etc., whatever it is. How I can reduce the risk? If you can remember last classmate, there is a stock 1, stocks 2, and correlation between the two stocks gives the variance of the portfolio. I have to minimize this. This is the financial model. For minimizing the variance is nothing but your risk of the portfolio. Right? Now, this is a quadratic programming problem because of the presence of terms like x, j, x, y, z, etc., objective function. Now, this is a little more complicated, but it can be solved with the computers very fast. But that's how you do you in your study material also you will find, and you can solve this problem, small problems, not big ones, with 2-3 stocks only, because beyond that it becomes very difficult to handle. Then there comes one Lagrange multipliers techniques. The above kind of non-linear minimization problem can be solved by applying Lagrange multiplier technique. It's a technique again like this, something where it is comparatively linear. Here you have quadratic 2, 3, 4, 5, 6. So there you do a linear format pay, another thing. Now once you use this formula, suppose computer में आपने data डाला, निकल गया data. What do you do next? Tracing the efficient frontier. The process discussed above can be repeated to find as many points as desired on the efficient frontier. Please follow me. The process discussed above can be repeated to find as many points as desired on the efficient frontier. Each time starting with a specified target expected rate of return. Please note here, every time I am trying to fix my expected return first because that is easier job. And now out of forget about 5,000 stocks. Let us take 500 stocks, NSE 500 or BSE 500. Forget about that, 200 stocks. Now there can be multiple combination. You can take 2, you can take 5, you can take 9, you can take 10, you can take 20, and there will be variance. There will be these functions. There will be 2 stocks. There will be 3 stocks. There will be different variances, etc. So all these things will ultimately give you a result. So you get multiple points, as many points as desired on the efficient frontier, which are optimal in the sense. All the efficient frontier may optimal. For that risk, you get that return, or for that return, this is the risk level and you get the adequate return. In actual practice, standard computer packages are available which can find quickly and accurately what are the combination I should be putting in my portfolio. So as you have seen in the mutual fund and other thing, time to time they monthly they come out with the data. They have sold off some of the securities, they have bought some of the securities. What happens is that they continuously try to do that and try to be in the efficient frontier because that gives you the highest possible return for a given risk. So they're continuously doing that, and when you continuously doing that, you may think I will get out of JSW Steel, I will get into Tata Steel, I will move out of HDFC, I will HDFC Bank, I will get into ICICI Bank. And what happens? If you think it falls into the efficient frontier, I go and buy. How much I will buy? That is also a critical decision I have to take. So, going slowly, what happens is that when I try to be in the efficient frontier, I look at individual stocks, their covariance, then I add another stock X, Y, I, J, K, and then now how they are correlated, and then how many I will put in my total portfolio, and how they will act, and when I will get the efficient frontier. It is just in from the another angle. If you put different kids in a room, one kid may be behaving in a different way. When the 2 kids come, they will behave in a different way. Third kid comes, they behave in a different way. Then there are 5, 10 kids, they are behaving in a way. You want the most efficient way they are behaving. It's just like that. So if you have a historical knowledge about the students and other things, you know which students to put in a class. Similarly here, if I have the historical data based on which I'll do the estimated return, I will try to reduce the risk now. This is the function for minimize the variance. This is the algorithm, a financial model. The process discussed above can be repeated to find as many points as desired in the efficient frontier, each time starting with a specified target expected return. So I'm starting from this is the return. We should try, if I take these stocks, easy to calculate, yesterday we have done it. And then how to minimize the variance or the return, the cost. So I may reduce quantity of this stock, I can reduce quantity or increase quantity of this stock, etc. Because each stock correlation coefficient might be different. So some stocks might be behaving badly after coming with all these stocks. So I'll reduce that stock, but the stock is giving good return. So I'll keep it there, but I'll reduce the quantity maybe. So this is how continuous monitoring I do, and I keep shuffling my portfolio. So this you will find if you check mutual fund, and you can do in your from based on your study material, you can work it out, calculate how to get this efficient frontier. But you will get with couple of figures because if you do it with unless you do it with computer, it's very difficult. Now this is difficulty level I am telling you. Now once Adequate efficient portfolios are determined. It is simple matter for the computer using its capability of graphics to draw the graph of efficiency, which was talking. These different points. If you take this risk, this is the max decent return you will get. You are ready to take more risk, you get a better return. So this is the return, this is a risk matrix. So following figure shows graph drawn from a computer package. This is actually one of the companies. Based on what we have calculated here, we have calculated here the X1 expected return. We have calculated here expected return. We have calculated here expected return of the another stock, the correlation coefficient of that, and then minimize the variance, and then we try to have this is also two stock model like we have progressed. Now Marco is very learned person, he has told it. So the question is that limitation of this approach. The problem is made more complex by the number of estimates or covariance or correlation required. I was telling you, let us take NSE 200 or BSE 200. If you want to choose out of that how many I will take, you have to choose, you have to do calculation with 200 shares. So if you want to compute with that, you will need 19,900 variance calculations. Now think of it if you are doing in a global scale. You want to build a global portfolio. So how much you have to do? 19,900 variance within a small time is very difficult job. So this is a big limitation of the approach. Of course, computing power have increased, but still, because it has increased now, people have also increased the number of shares. Now, it exponentially it increases. Suppose in case of 200, I am now considering very small caps out of 500. Now this number of covariance I have to calculate will jump above lakh. Okay. So this is a big limitation of this efficient frontier. As I told you, we will study what is efficient frontier. Logically, it's a very sound system. And then there are certain limitations when you do on a daily basis or monthly basis, your portfolio management, or you construct the portfolio, then observe the performance of the portfolio, then you buy, you can sell some stocks out of the portfolio, that is rearrange the portfolio or portfolio restructuring you do. So you have to continuously be in touch with the market. You have to see that your estimated income का side में company जा रहा है कि नहीं, the risk you thought, whether it is more or it is less. So you have to have a continuous monitoring of your portfolio. You cannot just make the portfolio and sit tight unless you are investing in an index or something like that. Having said that, let me come to, so efficient set you have, we have completed it. As I told you, minimization of the risk is important because we know the return and other thing. And this is the process you have to follow. Calculate portfolio expected rate of return, plot efficient frontier, select optimal portfolio. Once you select, and this is the definitely efficient frontier, how you go about it. Now, once you have done this, you will, as a simple investors, you do not have computers. Even if you do not, you can calculate your 10 or 12 stock and you can build up your portfolio, which perhaps for your risk level can be quite an efficient portfolio. Or it needs some improvement, that as and when you are trading or you are watching, you can understand that I can get a little more return if I move from ICICI Bank to Kotak Bank, or I can get more, I can reduce my risk if I move from, say, IndusInd Bank to HDFC Bank. and you rearrange your portfolio. Now let's come to the sharp single index model. Whew. Let's take a little rest. I'll start slowly. We get such a capability with single index model developed by a student of Marquis named William Shaw. What happens is that, as I told you earlier, that for 200 shares, there are 19,900 variations. For 500, there's more than lakh. Harry Marquis's student, Sharp, he came out with some solution and developed single index model in 1963. You remember 1952 when Marquis came out with this efficient frontier concept. Now the single index model is widely employed nowadays to allocate investment in portfolio. Investment in the portfolio, which share I'll buy, another thing, etc., etc. While the original, more general model of Marquis says how much asset allocation I'll do in equity, how much I will do it in bond, how much I will do it on other things. So both the models are working in a different level. Marquis says कि widely used to allocate investment between types of assets, such as bond, share, real estate, कितना क्या डालना है आपको, but कहाँ पर डालना है, that decision I am now taking from single index models. I don't have to calculate 20,000 variants, another thing. I can do it in a much more simpler way. That model has been designed by William Sharp. So what he says is that there are some assumptions like any model. The single index model assumes that return of various securities are related only through common relationships with some basic underlying factor. I'll repeat it. The single index model assumes that returns of various securities are related only through common relationships with some basic underlying factor. Now, this can be anything. For an example, I am telling budget. So there might be stocks will move and returns. Suppose today's beginning and today's end. That is your return. So return on the securities will be related only through common relationship with some basic underlying factor. What is that? There is a budget declaration. So budget में किसी का good news, किसी का bad news, किसी का news is confused. So accordingly, they will be opening price and closing price will be different, and you will get a different rate of return. So they say, single index model saying that these returns of various securities are related only through common relationship with some basic underlying factor. So every day there are some factors, and based on that, some securities are moving and giving you a return. A casual observation of share price movement at least tends to support this line of agreement. I'm sure you all agree. A casual observation of share price movement at least tends to support this line of agreement. What do you mean by that? Every day you find that some prices have gone up, some prices have let up. Something has happened, that is why this has happened. Some underlying factor. And this also is correct. The next line. There is considerable evidence that when the stock market goes down, most shares tend to decrease in price. If you are watching CNBC TV 18 or any other news channel, you will find that today market has gone down by 200 points and most of the shares have gone down, maybe some shares have gone up. So 46 shares in Nifty has gone down, 4 has gone up. So there are some common factor which has resulted in this. Those stocks had different type of risk. So they have not gone down, rather they have moved up or whatever it is. So assumption is quite simple. They say you don't have to track so many correlations and other things, etc., etc. You see the underlying factor and how the stocks are reacting to that. I hope I'm clear. You have to understand the underlying factor and you have to understand how the stocks are reacting to that. One stock will react differently, another stock will react differently. That you observe. It appears, therefore, that one reason share returns might be correlated is because the common response to market changes as measured by movements in, say, share price index. Now I come to the line. So it appears, therefore, that one reason share returns might be correlated is because of common response to market changes as measured by the movement in share price index. So say Nifty. Nifty has gone up. You will find some shares have gone up, some shares are up, not so. Some shares have gone up more than Nifty, some are less than Nifty, some have not gone up, they have gone down. So this you can study. In fact, this can be a homework. You can study in a monthly return of the Nifty and return of the Nifty stocks, whether they have gone more than Nifty or equal to Nifty or less than Nifty. So that will give you an understanding of 50 stocks ka correlation with Nifty 50. I hope this is a simple model. You can try and you will learn a lot from there. What you have to do is that you take Nifty first of the month, Nifty last of the month. You see how much Nifty, you forget about dividend and other total return. You just take Nifty value and the beginning opening of the month, closing of the month. You can take opening of the Monday, closing of Friday also. So you get 4 datas. And then you see what are the different stocks in Nifty, how at what they have opened, at what they have closed. So you will know how much percentage they are correlated with Nifty. Similarly, you will find some stocks have gone more than Nifty has increased. If you convert that into percentage, some you will find they have moved in the same direction Nifty has moved. That means if Nifty has moved up, they have also moved up, but not up to the level of Nifty, less than Nifty. Some might not have moved up, rather they have gone down. And some have moved marginally, negligible. So if you do this, you will have an understanding that how these Nifty 50 stocks are related or correlated to the price index, that is Nifty 50. So if you do 4 weeks, then you can understand that this is a pattern and where there is an aberration. In the sense, every time Nifty has gone up, whether the stocks have gone up or not, or sometimes it has come down, or if Axis Bank has gone up, whether the other banks have also gone up, or what has happened, these correlations between the stocks also you can find out. This is a very simple, manually possible, or you can just use a simple computer in Excel. You can do it and find out this relationship. Having said that and giving you a homework, let me move to the next slide. Now, to understand the said assumption of the single index model more precisely, consider the following figures where we have related the returns of a hypothetical share, not hypothetical actually, we have done ACC and to the return of the market index. Okay, I am not giving the time frame. So what has happened is that it has been done over a period of time. And over a period of time, that is why there are different places This is Sensex return and this is SSC return. Okay. So Sensex and how these dots are the line. So this is your hypothetical share of the return. The line running through the scattered points is the line of best fit. This is the line running through the scatter point. Okay, this is the best fit. Why? Or an estimate of what is known as shares characteristic line. That means ACC सेंसेक्स का कहाँ कितना दूर जाता है, सेंसेक्स का साथ ही मूव करता है और इट मूव्स मच अहेड मच लोअर समटाइम्स, बट मोस्टली इट इज अराउंड सेंसेक्स. सेंसेक्स अगर ऊपर जाता है तो वो भी ऊपर जाता है, थोड़ा कभी ऊपर जाता है, थोड़ा कभी नीचे जाता है. दैट इज द कॉन्सेंट्रेशन. Yes, sometimes it has gone up, sometimes it comes down, but those are rare elements. I'll repeat it again. Now, this is in horizontal axis, you get Sensex return, vertical SSC return. Now, dots are the returns. Now, this line is the characteristic line. Okay. So here what I find is that this ACC has more or less remained along with the Sensex. If Sensex has moved up, it has also moved up. Sensex has gone down, it has also either down or up or like that. It is surrounding the Sensex. Yes, sometimes it has gone down or sometimes it has gone up, sometimes it has gone down and like that. So this is the line and along with, so it is more correlated with, I can say, Sensex. So that means if Sensex goes up, in probability ACC will go up. Sometimes you will see, if you see in a monthly basis, every day you see the data monthly, you may find that most of the days HDFC Bank or RIL or TCS, some of them have gone up. That has made Nifty to go up like that. Now the line running through the scattered point is the line of best fit or an estimate of what is known as the shares characteristic line. Algebraically, the characteristic line can be defined as R1 is equal to alpha 1 plus beta 1 plus Rm. Now I will explain you what is R1. R1 is the return on the security. Alpha 1 is now the security price moves because of the strength of security to some extent. Uska baad there is a momentum in the market also, market news also, overall market sentiment also. Please understand, these are behavioral things also in the market. So if those things also not happened, because SSC is doing well or something, SSC would have given some return to you. So we are talking about that return, alpha I. This is that return, component of share I's return, that is independent of market performance. In the sense, kya market mein psychology, market acha nahi tha, bura nahi tha, that is secondary. Standalone ACC would have given this return, alpha 1. RM is the rate of return on the market index at random variable, because this is what I cannot have any control. Market return, it depends on how many people are, what mood, what share trading and etc. How much market in the beginning, market at the close. Dividends are not taken into account in this type of calculations. When you do empirical calculation, then you take the dividend. Otherwise, you are not. You are seeing Nifty is 24,700. You are seeing Nifty is 24,300. So 400 point Nifty has gone up. You convert into percentage. You know the return on the Nifty that day. Okay. So this is a random thing. This can be anything. It can go down. It can go up, etc., etc. Now beta, the slope of the characteristic line, that measures the expected change in R given a change in RM. Market अगर ऊपर जाएगा या नीचे जाएगा तो बीटा कितना ऊपर जा सकता है या नीचे जा सकता है, or how it will react, that is given by beta. So beta actually we calculate with 5 years past performance, 3 years past performance daily. If we take, if Nifty has moved or Sensex has moved, SEC has moved how much? There can be plus, there can be more than Sensex, there can be less than Sensex but positive, there can be negative. That means not the direction in which Sensex has moved. So if I run a statistical program called regression, I get the beta of any stock, here ACC. So that gives you, generally this is, if it is 1, that means if market moves 1, this will also move 1. That means market अगर 12% बढ़ेगा, वो भी 12% बढ़ेगा. If that is 1.5, let us say, ACC, तो market अगर एक 10% बढ़ेगा, that will go by 15%. And reverse is also correct. If market goes down by 10%, it will go down by 15%. That is what beta is. So beta can be less than 1, beta can be more than 1, beta occasionally can be negative also. Negative matlab, it does not move the way market moves, it moves in the reverse direction. This is the characteristics of the stocks. So I repeat again about this formula and also beta and RM. So RI is your return on the security. This is standalone, irrespective of how market has done another thing. ACC का अपना मुद्दा है, return. And this, because market has moved up or down, and this has a relationship with the market, because of the market effect, there is some additional or minus effect, and then the total return is this. So RI is return on the security. Alpha 1 is the standalone return irrespective of market performance. ACC का. RM is market का जो return, and B1 is the relationship of R with RM. Market अगर बढ़ता है तो how much this will also go up. So effect of market में हमको कितना रिटर्न मिला है और ACC का अपना मुद्दा में हमको कितना रिटर्न मिला है, दोनों मिलाने से I get the total return. So market link return, I am getting something, I am segregating both, market link return and one is standalone return, and then I am getting the total return. This is important assumption. It implies that only reason shares vary together systematically is because of a common co-movement with the market. Thus, single index model assumes away all other possible effects on share returns such as industry effect. So क्या हो रहा है? This line is a repeat line, last line. So single index model assumes how industry has done and other thing, those possible effects on shares returns are secondary. The main mudda is that how the company has done and how market has done, and in relation to market how the share has done. If you combine the two, you get R1. Or the return. As I told you, first we need the return, then we move to the risk. Now we will study two risks, systematic risk and diversifiable risk. Actually, we have covered this long time back, I think yesterday's session or earlier. Let me read it out. Even though shares have many common characteristics and as a result tend to move together, जिस दिन बाजार बढ़ता है, many stocks go up, some stocks do not. Tend to move together, their numerous individual and distinguishing properties cause shares to co-move with the market at different rate. This is what I was sharing with you. Market has gone up, some share will go equally high, some will go the same direction but not fully, some may not go in that direction. Accordingly, how sensitive a share's price is to changes in the overall market, thus the value of its beta is of great significance in determining the expected return. That is, this beta, as I told you, how I am related to the market return can significantly increase your return or decrease your return. So this is important to understand. Now, risk. Like expected return, I segregated into two parts. One, standalone for the company ka kya, another is market effect. So, like the expected return, we can always split the variance of the shares. Variance means risk. Shares returns into two parts. One is systematic risk or market risk of the investment. The second component of the variance of shares return is known as residual variance or unsystematic or diversifiable risk. So one is systematic risk, to simply put, one is systematic risk or diverse systematic risk, and one is unsystematic risk or diversifiable risk. The systematic risk is caused by macro events like oil crisis, unexpected change in rate of inflation, the macro event, a broad effect, and affect nearly all shares to one degree or another. So this will be affecting everybody. You can't do much about it. Yet you can be affected X, another person can be affected 2X, another person can be X minus. But effect will be there on all and it cannot be protected. Thus, one cannot reduce systematic risk by diversifying investment across different shares. That is why systematic risk is often called non-diversifiable risk. Whereas the second component is diversifiable. As I told you in the last class, if you buy different stocks of different characteristics or industries and other thing and diversify your portfolio, you may reduce that diversifiable risk to almost zero. Because the source of this kind of risk is micro event which impacts some stock. Some steel policy change, so steel price kamti ho jayega. Lekin HDFC will go well, bank will do well, so your portfolio return will be good and your risk will come down. So you will ultimately reduce the risk. The single index model does not require even the indirect estimate of covariance of returns between shares, as I told you. The model provides a still simpler formula for computing variance of portfolio returns. In fact, honestly, for if you are doing it here for 200 shares, only 200 data will be required, not 20,000. So let's summary what we have covered today. This unit provides some insights into Marquis' model to trace the efficient set. That's the first thing we understood. What are the possible efficient set among the humongous number of stocks, 5,000 stocks. Marquis model requires estimation of large number of covariance. I told you for 200 stocks, almost 20,000 covariance you have to find out. And without having estimate of covariance, one cannot compute variance of portfolio return. So you need a huge power computer in those days. This makes the task delineating efficient set extremely difficult. This is what my purpose was in the beginning when I said the objective of today's study. Delineating efficient set, extremely difficult. 63 May came his student, William Sharp, with single index model, simplified it and said that all shares are somehow or other linked to some one event or something like that. So even with a large population of assets from which to select portfolio, the number of required estimates are amazingly less than what are required in Marquis model, as I told you. So if you are dealing with 200, you only 200 estimations are required, 200 shares, how they are linked to the index. That's what you have to calculate and select the stock. So this is the simplicity William Sharp single index model brought in. Now, accuracy again, that is very important, of the latest model, that is William Sharp's model formula for portfolio variance, that means risk, is as good as the accuracy of its underlying assumption. So, the assumption is simple, as well as the risk or portfolio variance is also as good as the accuracy. That's the beauty of the Williams single index model. So this is the summary of today what we have covered, and this brings us to the end of today's session. And more on the portfolio we'll have in the next session. Thank you. I'm Binod Gopal Mukherji.